Equity benchmark indices BSE Sensex and NSE Nifty are eyeing to close the current calendar year with strong double-digit gains. The two indices are up 18% each for 2023 so far. Sectorally, Nifty Realty, Auto, Pharma and PSU banks are leading winners with gains of 29 to 77%. On the flip side, the financial pocket including private banks, metals and oil and gas indices pale in comparison with gains of 11 to 15%. The high interest rates of 2023, analysts say, led to a slowdown for major economies including China, which is why metals underperformed. Cheaply priced public sector banks attracted more investor attention as compared to private peers. While the subpar performance in the oil segment was due to crude remaining elevated for most part of the year.
The first year of those interest rate hikes, we would see the loan portfolio of the banks getting repriced to the prevailing higher interest rates. And that would translate to better spreads and net interest margin for the bank. So that helps in better profitability. And in the subsequent periods, what we would see is even the deposit or the asset side of the banks would get repriced to those higher interest rate environment. And in that scenario, the spreads or the net interest margin of the banks tend to compress a bit. And that has happened in the last year. If you look at the metals landscape, in most of the commodities, almost 50% of the demand and supply is controlled by China. And China had a muted recovery over the last year, and the recovery or the growth from China was much lower than what the most of us anticipated. And therefore, the metal global demand was weak, and that translated to limited improvement in those metal prices.
For 2024, private banks are expected to make a comeback riding on rate cuts, firm credit demand, and inexpensive valuations. The trajectory for metal stocks hinges on demand acceleration in China, while there is uncertainty on the oil and gas bucket as crude prices may remain high, limiting margin gains. Thus, analysts suggest remaining selective on the latter two.
If I combine the valuation comfort plus how those fundamentals are panning out, clearly the pecking order is the banks or the banks stands first. One, the reasonable valuation is quite reasonable compared to their long-term history, or even if we were to assess their fair value. So that there is a better margin of safety in that bank's pocket. The second preference could be for metal sector. As interest rate moderates, we could see some kind of pickup in the global growth, and that should benefit the overall metal prices. Private banks, from even from a bucket perspective, it looks quite attractive, even if we were to take that group as a cohort. But when you come down to oil and gas and metals, you have to be very selective.
Moreover, within the oil pockets, select stocks like those of OMCs have rallied this year, even as the oil index has lagged due to RIL's high weightage. Analysts at BOB Capital say these gains have largely captured the benefit of likely margin expansion, and there are limited triggers for a further rally in OMCs in the near term, as marketing margins will normalize with historical losses being largely recouped. Proximity to general elections also limits near-term upside to margins, they add. Thus, investors should bet on private bank majors and keep a cautious approach to metals and oil-related shares. Today, on 28th December, stock-specific action will continue and a new IPO listing of Azad Engineering will be tracked.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.